Hello dear aspirants, welcome to Goldfinch IS and KS Institutes. In today's topic, we're going to discuss about current account deficit. It was in news in 2023 and very important for your 2024 prelims and main examinations of UPSC as well as for Karnataka Administrative Services. Okay, so to understand what is current account deficit, we must understand what is balance of payment. What is BOP is all about, balance of payment, and how export and import and the crude oil plays a very important role in balance of payment. This particular video is all about it. Balance of payment, according to the definition, it means the record of economic transactions of the residents of a country with the rest of the world during a particular period. If you take India for an example, if you take India for an example, there are a lot of people in the country. You can take A, B, C, D, lot of people are there. We have 140 crore people, right? We are not producing everything whatever we want. We want a lot of commodities for our day-to-day consumption. Everything is not produced by India only. We have dependent upon other countries for certain commodities. You can take an example of crude oil, petroleum products, gems and jewelry, and engineering products, right? For all these commodities, we have dependent upon other countries, right? So whenever we buy these commodities, we will make the payment in terms of hard currency. That is, it may be in the form of dollar or in the form of euro, in the form of yen, whatever, right? In this form, we will be making the payment for our compulsory imports. You understood? So this transaction, how India is doing this transaction with the rest of the world, in the same way, how the rest of the world is doing the transaction with India, calculation of this is the balance of payment. You understood? Payment is consisting of two important accounts, current account and capital account. If I tell you current account, it does not change in any assets or liabilities. Current account is something like the income which comes to your country, and it will not go by itself until unless you spend the currency. See, for example, it is like your salary. If you receive a salary on a monthly basis, until unless you spend the salary, it will be with you only. Correct? Capital account is such like loans. If you taken a loan from somebody and it is not your salary, you cannot spend by yourself, like whenever you want or however you want, because you have taken a loan for certain reason. For example, paying the fee, you have taken a loan and you have to return it back to the person from whom you have taken the loan. Correct? No? Capital accounts are like that. It is like it creates the liabilities. Capital account creates the liabilities and or decreases the assets, but current account will not decreases the assets. You understand? And it does not change any assets or liabilities. Okay, if with respect to current account, what it includes mercantile trade, which means imports of commodities and export of commodities. For example, we are importing for 100. Let us take we are 100 around $100 we are importing, and we are exporting around $200. If you are importing $100, exporting $200, it is surplus export. It is export surplus. If it is reverse the case, which means if you are exporting $100 and importing $200, then what it will be? It will be the deficit. No, it will be the deficit, right? If that shortage is happening with respect to current account, it is called current account deficit. Not only with respect to mercantile trade, it includes mercantile trade, invisibles, and it is transfers, right? So what is visible here? That is mercantile exports and imports, because goods and services are visible, right? So invisibles include services like banking, telecom services, factor income. That is, see, for example, if Indians have invested more in foreign countries, they will make profits. And if they have invested in stock markets of foreign exchange or stock markets of the foreign countries, like for example, in Indians are investing in Microsoft, Google, etc., so they will definitely earn some interest. And if they have invested as an investors, they will definitely earn some dividends. These all comes under invisibles, right? Transfers meaning gift given to some persons or country, right? grants given to India, remittances coming into the country. Foreign many Indians are working in foreign countries, and they will send some money to their dependents in India. Right? That is called remittances. And what do you mean by grants? Grants used to send $150 million every year to India because kind of a compensation for India to develop the poverty condition in the country, right? Like even United Nations do like that, such grants will come to country because these are all like your salary. It will be staying with you for so long until unless you spend the money. You understand, right? These are all current account. Capital account meaning foreign institutional investment, which means foreign investments like foreign direct investment, foreign portfolio investment, which includes foreign institutional investment, and foreign qualified foreign investor, which means the foreign investment coming into your country, external loans, you're borrowing money from other countries, right? And NRI deposits, the non-resident Indians are depositing in the country. These are all comes under capital account. You understand, right? You don't know when the investment come to your country and when it will go out. If your country's condition, economic condition is good, they will stay in your country. If the country's economic conditions are not good, they will not stay in your country, right? But whenever you export, you definitely receive certain amount, right? And that will be subtracted with the imports. So you got the differences between the current account and the capital account. Current account is like your salary, capital account is like your loan, right? Salary you can spend at any time. If mercantile trade, invisibles, transfers, if they are all in surplus, then it is current account surplus. If all of them or few of them are in deficit, it is current account deficit. Let us take an example here. Mercantile trade, if I put together, see, export minus import, I have a shortage of $100, minus $100. In services, banking, telecom, factor service, etc., I can assume that it is equal or it is nil. I'll assume that it is nil. And I take transfer payments. Rather than India receiving more gift, India is giving more gift to other countries like Indian neighbors. Right? So if that is the case, again dollar is minus $100. What is the total deficit for India? $200. That's $200 million. You can take whatever the example. So that is current account deficit. In the current account, we have a shortage of 200 million here. You get in the point? Because we are exporting less and importing more. And very less services are coming into country and more services are given to foreign countries. More gift, very less gift is coming into India and more gift is going out of India. More grants are coming less to India, grants are less coming into India, and more grants are going out of India. Whenever this happens, it is going to create a deficit, which is called current account deficit. I hope you understood, right? What are the threats from current account deficit? If current account deficit continues, what is going to happen? What is the problem is going to create? Pull out of the foreign institutional investors investments, because nobody will stay in your country. Nobody will invest in the stock market of your country. Nobody will invest in the already existing companies of your country, right? The investors' confidence will be lost if the current account deficit more, right? You may ask me, sir, why investors will not invest in your country if current account deficit is more? Because if current account deficit is more, your country is exporting less, your country is receiving very less tourists, your country is receiving, very less dollar. That is a hard currency. Your country is receiving very less hard currency. If your country is receiving very less hard currency, your country's economic performance is low. That is the indication of it. That is the reason investors lose the confidence to invest in your country, because they will not get good return while going out. For example, if they invest on $100, they will not have a confidence of taking back at least $120. If they have a confidence of taking back $120, they will definitely invest. Because if your current account condition is not good, right? What happens to Sri Lanka? Take an example. Sri Lanka's current account deficit has tremendously increased. So tourists stop going and investors stop investing. And the Sri Lankan people, Sri Lankan investors stopped investing. You know that. Even same thing happened with Pakistan. You got it. Exchange rate fluctuation happens, right? See, for example, if today is 80 rupees per every dollar, right? If 80 rupees is for every dollar, if this happens, if fluctuation happens, that you go, if it becomes 100 rupees for every dollar, what is going to happen? So don't you think the commodities in India is tremendously increases, right? Because for every dollar you are paying 100 rupees. Take an example. Let us assume that 1 liter petrol is $1. When it was 80, you used to pay 80 rupees from your pocket and you used to get 1 liter petrol. Right? So it will be 80 rupees only. Whenever the exchange rate fluctuation happens and rupee devalues to 100 rupees to, sorry, 80 rupees to 100 rupees, if rupee devalues, rupee value decreases from 80 rupees to 100 rupees, then what happens to the same petrol? Now the same 1 liter petrol you'll be buying it for 100 rupees, which means the petrol prices increases. If the petrol prices increases, don't you think commodities, all commodities prices will also increases? This is how exchange rate fluctuations will play an important role. And because of the change in exchange rate, what it is going to lead to? It is going to lead to inflation. Earlier, petrol price was 80 rupees. Now, petrol price is 100 rupees. As earlier, one chocolate was 80 rupees. Now, the same chocolate is going to be 100 rupees because importing of the chocolate is required transportation. That is the reason price of the particular chocolate is also increased. That is inflation. Price increase may lead to BOP crisis. BOP crisis meaning we are importing petroleum products, we are importing crude oil, we are importing engineering products, lot of products we are importing, and we have only $100 million with us to pay, but actually we have to pay $200 million for all these imports. If we have a shortage of $100 million and we are not generating enough dollars to pay this back, such a situation is BOP crisis, balance of payment crisis. I hope you understood, and let's move on to the reasons. What are the reasons for the current account deficit? The reasons are, I can simply write some of the reasons, right? Because of increase in the demand domestically, right? Or domestic demand increase. If we increase demand for imported commodities, if you're preferring to buy more of imported commodities, definitely current account deficit will increase because we import more. As we import more, will dollar inflow increases or dollar outflow increases? Dollar outflow increases because goods will come to our country and dollar will go out of our country. Getting the point? And second reason is, our biggest reason is energy import. That is crude oil. India is importing more because of energy. You know that because the trade deficit, if you take in US dollars count, $192 billion in 2021 and 22 is actually the trade deficit. That is particularly the mercantile deficit that we have seen earlier here. You see this mercantile deficit, that is imports and exports. You got it? In that, the highest deficit, that is $192 billion trade deficit we have. That is the mercantile trade deficit. $192 billion. You understood? And the third reason, oh wait, and the third reason is uncompetitive exports. Because Indian commodities are not competitively sold in the international markets. That is the reason exports from India is decreasing. And the fourth reason is rising the global commodity prices. Global commodity prices are increasing. Why? Because we know already many reasons. That is the Ukraine-Russia war is going on, right? The wheat and crude oil price increased, and the Israel and Palestine, that is the Gaza issue or the Israel-Palestine war is going on. Again, the rising prices, right? These international crises leading to increase the crude oil prices, that is also affecting, right? These are the very, very important four reasons for the current account deficit. Then what is the remedy? What we have to do? Right, first we have to increase the exports from India, right? And we have to take a lot of actions with respect to increasing the exports, right? What a second, see, it is not possible that okay, simply one day we can increase the exports. It will take a lot of time, and we have to produce such commodities, such quality commodities that create the international demand. right? And we have to stop or decrease non-essential commodities. What do you mean by non-essential commodities? See, for example, crude oil is essential. Engineering products are essential, right? See, for example, toys, right? And some of the basic clothes, right? And sandals, that is slippers, etc. Because these can be produced domestically only, no? We can stop importing such commodities, right? And third and very important one, we have to gain the investors' confidence. If we get investors confidence good, then they will start startups here in the country, and they will do trade with India, they will buy more commodities from India, then exports will definitely increases. And last but not the least, the country should also balance with respect to fiscal consolidation. That is fiscal consolidation. What do you mean by fiscal consolidation here? The FD, see, for example, in the last class I have discussed what is fiscal deficit all about. Fiscal deficit meaning the total expenditure of the country is exceeding the total income of the country. The total expenditure of the country is 150, the total income of the country is 100. Then what is the shortage? 50. This is fiscal deficit, no? So this fiscal deficit need to be decreased. That is what is fiscal consolidation measure. If this need to be decreased, what government should do? Government should gradually, or wherever the possible areas there, they have to increase the taxes, right? And they have to decrease the expenditure of the government. You got the point. This is what is fiscal consolidation measure, right? I hope you understood this particular concept, and thank you so much for watching. Thank you, and please subscribe the channel.